Do you expect it up 700 and then finish basically flat up 100? Come on.
Well, there's a lot of things still wrong with this rally, Scott. And one is that we've seen a huge uptick in defensive trading just in the last month. I mean, utilities have outperformed technology by over 500 basis points. So this is not your average December. Technology, to its credit, it has rallied about 3% this week, but it's still underperforming and not really moving up that aggressively. And so, a lot of my work shows a stalling out and a mild pullback between now and likely December expiration. I do think the last 7 to 10 days are probably higher in the market to end the year on a good note, but this isn't going to be your rip-roaring rally where everything just takes off. And I think there's one thing for investors to pay attention to. It's the fact that inflation data came in tame today, but yet look at the 10-year yield. That's up about 10 basis points off the lows. So 2-year fell. If anything, we're seeing the start of some steepening now on the yield curve, which I think will be led by the 2-year. But anytime we see a big move higher in the long end of the curve, that's typically not a great sign for technology. And I think that could continue to be the case over the next couple of weeks. We could see tech lag as yields start to move higher.
I mean, looking at the 2-year as you're talking, because those, there are people like Gundlach, for example, who say that the 2-year leads the Fed. Fed's, right. I mean, the 2-year's at 422.
Well, it might be tough to see the 2-year get down meaningfully under Fed funds. I mean, my thinking is it can get to 4%, but the 10-year I expect to stabilize and actually rally a little bit in terms of yield. So, if anything, we see a bounce in 10s and 30s, while 2-year, we'll see a little bit of a steepening. Tough to know. In general, inflation continues to come down, and that's what our own Tom Lee has been talking about for quite some time. So I know you'll have the chance to talk to him tomorrow. But look, markets are at a critical make or break here on the upside. We've seen a good rally in a lot of different sectors: industrials, healthcare, discretionary, financials. It just hasn't really been in technology. That's really a key piece of the puzzle, with Apple being 7% of the S&P, and it's been range bound since May.
I know, but couldn't you make a counter case that it's actually healthy, that it's in other areas of the market, particularly more cyclical areas than mega cap tech?
I do think that's one thing the bulls have going for them heading into next year. We have seen the rest of the market rebound pretty strongly. I would also mention, the majority of institutions I speak to remain on the sidelines. So everybody's got this forecast that we're going to have a weak first half and then rally. It makes me, really hard to think the market's going to have a huge decline if everybody's already on that side of the boat and thinks that's going to happen. So, we'll wait and see. I am thinking that upside's going to be tough from here in the short run, but I'm not convinced that we have to have a huge bear market further into next year if that's really what everybody else is thinking.
But you almost paint a picture where tomorrow doesn't matter, that stocks are not going to rally for all the other reasons that you suggested, no matter what the Fed chair says, barring some incredible shocker that's, unbelievably dovish.
Hey, as you know, Scott, I don't look at fundamentals or macro to make decisions. And so a lot of this is based on momentum and breadth having rolled over, an uptick in defensive trading, technology just not able to rally, and a lot of the cycles starting to roll over. DeMark exhaustion, for those that study that kind of thing, is going to be present within the next couple days. So there are some reasons to think that this December is going to be different than your normal December. I'm very willing to participate if the market rips up above 42.50, because I know people are going to be caught flat-footed and they'll need to catch up. But I just don't want to take a lot of risk right here ahead of the Fed. And I think today's reversal was pretty important, and it's important for investors to really concentrate on what yields are doing on the long end of the curve.
All right. I guess that's why you guys are the technicians. You take the emotion out of it, if you will, and the fundamentals, too. We'll see you soon. That's Mark Newton. All right, you as well. Mark Newton of Fundstrat there. Up next, we're following